In this video, we'll be taking a look at the easiest entry models that you can use for any strategy. Now, the first type of entry that we will be going over is a simple break of candlestick. This is when one candlestick engulfs another candlestick fully. We can wait before the candlestick actually closes, or if the candlestick hasn't closed yet on our time frame, we can get in before that close. And lastly, this is the most reliable and consistent entry model that we are going to go over from this list. This is the first example we'll go over. As we can see right here, this is our supply and demand zone. It can be any other strategy you want it to be. But since we are buying, what do we want to see? We want to see more buying pressure coming in after it touches our zone. So this red candlestick, we don't get in because it doesn't engulf this candlestick right here. The next candlestick is this green candlestick. Now, if we zoom in very closely here, we can see that it did engulf this red candlestick, but we can see that before it closed, sellers pushed back on this candlestick all the way back down. That's why I say you can either wait before it closes to get in, but sometimes this happens and you can get manipulated, or you can wait until the actual close of the candlestick and you would have gotten in on this one, but you'll sometimes get less risk to reward. So this candlestick right here is the candlestick that is the entry. Why? Because we engulfed this entire candlestick. So we break above this, our entry is right here, and then we get in. The trade does pull back on us a little bit, but then it ends up going inside of our favor. Here's another example of this happening on gold. So as we can see, as the candlesticks are reaching our zone, we see it tap into our zone right here, and then we're waiting for the next candlestick to break below this previous candlestick with momentum. We want to be careful because, as we can see from our last example that we had, the candlestick can reverse and move back up before the close. But a lot of the times that doesn't really happen and you'd be safe. It just depends on what you are trading. So we enter off of this candlestick break right here. Our stop loss goes right above that candlestick that we broke. If you want a safer stop loss, you can put it above your zone. If you're trading supply and demand, support and resistance, you could put it above your zone. But if you want more risk to reward, you can put it right above the candlestick that we just broke. And then we aim for lower or higher, depending on what direction you are trading. Now, if you are a beginner just starting out, you can use this on any time frame. It doesn't matter if it's the 15-minute, the 1 hour, the 4 hour. Go to the time frame you are trading on and wait for that break of candlestick before getting in. Now, here are some of the cons of break of candlestick. We've gone over what it is, how to do them on the charts. Now I have to show you guys the cons so you know what to look out for, because it is not a 100% perfect entry, but it is an easy entry. So the cons are that it gives you less risk to reward than the other entry models that I'm going to go over. And next, sometimes the candlesticks manipulate, as we saw from our previous example. So going to our example right here, when we wait for that break of candlestick, we get in up here. But with a lot of other entry models, sometimes we can get a better risk to reward by getting in inside of somewhere like here. So break of the candlestick entries are simpler and more safer, but you give up risk to reward because of that safety. Now, this next entry model is if you are a little bit more intermediate, and it is simply a change of character. Here, we wait for candlesticks on the lower time frame to switch direction before we get inside of the trade. Doing this provides a lot of certainty inside of our entries. So for this, as I've pointed out, you have to go to the lower time frame. The lower time frame I use is the 1 minute. So when doing a change in character, we want to identify the last leg at which price created that we want to see a break in. What do I mean by this? So we were selling down, right? And we want to overall buy. This point right here is the last leg down that we want to see broken above before we start looking to get inside of this trade. See how on this leg we just didn't start selling down more? We had this last leg, and then what did we do next? We broke above that leg. Similarly, here at this point, if this candlestick right here would have broken above this last leg, it would have created the same thing that we're seeing over here, but it did not. We rejected and started moving lower. But here at this point, we fully broke above this last leg. So that is our change in character. So here this is our entry. Our stop loss goes below this point right here. Why this point? Because this is the last leg before this break. And it's very important because if we're talking about market structure, like I said, if we're going to start changing bullish, we cannot break below this low. So our stop loss goes below that low, and then we aim for a 1 to 2 or whatever risk to reward you want. Here is another example of this happening on gold on that same zone that we had marked off. So what do we see? We see that price was buying into our zone right here. At this point, what do we want to see? We see price create this high. Where do we want to see that high being broken at? We want to see it broken right here in this area, because this was the last leg higher on this lower time frame. So when price breaks below this leg, and it actually breaks below right here, that is when we can look for an entry. So we get in right there. Our stop loss goes right above this last point right here, because that is our safe zone, and then we aim for whatever we want to aim for. So what are some of the cons of change of character on the lower time frames? The cons are sometimes you can get a less risk to reward, just like with break of the candlestick, and you have to adjust looking at the lower time frames like the 1 minute, which are super duper fast inside of real time. Now the last type of entries that I will be going over are aggressive entries. I call these degenerate entries, and you're going to see why. But these type of entries can become sniper entries if done properly. So let's go back to our previous example. If we are getting in aggressive and doing aggressive entry, we get in on the manipulation of this zone right here. We don't wait for a candlestick break. We don't wait for a market structure shift or change of character. We just get in once we see this rejection wick from this zone, and then we aim higher. So we get in right here. Our stop loss would go right below either the zone or the rejection point, and then we aim for higher. Let's go to our other example and show you guys the same thing. So here for this example, we would get in right here off this candlestick rejection from the zone, and our stop loss would go right above the zone. Now, if this candlestick had this red candlestick, if it had wicked above this zone, our stop loss would go right above that wick, and then we just aim for lower. Now, this is the main type of entry model that I've been using for like months, and I'm gonna show you guys. You guys have already seen the pros, which is good, very good risk to reward, because instead of getting in all the way down here, we're getting in immediately and just putting our stop loss above the zone. But there are a lot of cons to this as well that I'm going to explain. So some of the cons of aggressive entries is that you can be wrong on the timing, you can stack up losses way quicker, and then there is way less certainty. So for my beginners and intermediates who are watching this video, I want you guys to focus on a break of candlestick or a changing of character like we've gone over. And for my advanced people, if you want, you can go to rejection candlesticks. It will give you more risk to reward, but just be careful about when you're getting in and about not stacking up those losses, and also not being greedy. So that is it for this video. If you guys like this video, make sure to comment down below if you have any questions, and I'll see you guys next time.